So next up, we have the Capital in Transition panel featuring Samantha Gleit, Adam Rosenberg, Seth Yakatan, Dennis O'Malley, and moderated by Marc, Claybon. Everybody give them a hand as they make their way to the stage. Come on up, y'all. The stage is up here, y'all.
Last time you had me and Dennis on the same stage, I think it resulted in about 4 cease and desist orders for me. So I hope you're all buckled up.
Yeah. So good morning, everyone. Welcome. This is our first panel on capital in transition, how investors are positioning for cannabis's next wave. As we all know, the industry is in some transition, even more so over the last week. And things are constantly evolving. So we're going to look at how investors are viewing this transition. Are there any emerging opportunities that are going to happen, structuring deals, and positioning themselves for what's next? So why don't we start? We have a very experienced panel here that cover all different aspects of the industry. So why don't we start with some introductions?
Hi, I'm Dennis O'Malley. I'm the founder of Echtrai, which means journey in Gaelic. We are a boutique advisory firm hired by operators and investors and boards and CEOs to build out an office of the CEO. We're based in California, and we work with about 5 to 10 selected companies throughout the U.S. We do so on referrals only, and appreciate being out here.
Seth Yakatan. I have an advisory firm called Katan Associates in Ordo Verde, and I work as an advisor to Glass House.
Hi, I'm Samantha Gleit. I'm a partner at the law firm Feuerstein and Kulick. We are a boutique law firm that's focused in the cannabis industry, and I lead the firm's debt finance and restructuring practices. I work with companies and investors on primarily senior secured term loans and alternative investment structures.
Hi, I'm Adam Rosenberg. I'm an operator, investor, and advisor across marijuana, hemp, and biopharmaceuticals. Many of those companies partnered with the Vlasic family, which is the same family behind the largest pickle company. And I also serve as chairman of the board of the NCIA, the National Cannabis Industry Association, and have used that platform as a tool to host discussions among the hemp and marijuana leadership.
And my name is Marc Claybon. I'm a tax principal at Crowe. I spend a lot of my days structuring various tax aspects of the industry. But why don't we get started with the panel? Big picture, this is a question for the group. The title of the session is Capital in Transition. When you hear that phrase in relation to investing, what does it mean to you? Could it be regulatory, financial, structural, something else? Why don't we? Who wants to kick us off?
I can start with that.
Yeah,
so one of the big things we're seeing is what people refer to as the debt wall. Many folks are aware that many of the large operators as well as small operators have maturities of large debt facilities that come due this year. So we've all been watching as some of the larger companies work to restructure that debt. And a lot of companies, at least in my hemisphere, have been saying, what do we do now? When we took out these loans in 2020, 2021, everybody was really hopeful that there was going to be federal reform. We're still waiting for it. And now we're in a position where we have to restructure this debt. And it's really a game of cooperation. So we're seeing companies work together with their investors and finding consensual plans to ideally extend that runway and hopefully give a little bit more time until we see more federal reform, and also figuring out how to cost cut in the interim and really focus on those core markets and either get additional funding if necessary or really cut costs so that it can become more profitable in the interim.
See, I think we should rename the panel after last weekend to Capital and Stasis, because I don't really know that there's that much capital left outside of the kind of work that you're doing, right? Like if we were up here 18 months ago, there were 9, 12 private credit funds that were out there writing checks. Now there's maybe 3, and the other 9 are restructuring or retrenching into the deals that they're already in. And after you've seen, and I don't care what you think is going to happen, but after you've seen $100 million of capital go into hemp beverage that's now liquefied, I don't think people are really excited about writing checks right now.
I don't disagree, but I just want to add something slightly more optimistic to that sort of depressing headline, which I don't think is untrue. But we are seeing more banks slowly able to participate, which does help. So I don't disagree with that. But it does help that we've seen some more capital come into the market on more affordable terms, particularly for companies with hard assets. So it does help a little bit. But yes, I would say generally there's less enthusiasm, particularly amongst the private investors, which can be challenging.
Yeah, I mean, I see it as a complete barbell strategy right now, where on one end, it's heavy, which is rescue capital, in what I see as capital on one side. And the other side, which isn't talked about as much, but there's a massive competitive advantage for people to have a lower cost of capital when they're on the growth stage of working capital. The majority of people are not doing that through traditional cannabis channels. But I would say that the amount of capital that is being pumped in through debt, and Scott at Viridian did a great job in terms of looking at that, is such short-term focus. That is not great for the industry. I know that others said, hey, that's awesome that so much debt's coming in. To get what? Converted into equity? Again, we said it before, the largest MSO next year is going to be Chicago Atlantic. I mean, there's no way this gets converted into equity because there's no equity, and the amount of debt being poured into the industry is not going to be serviceable.
Any thoughts? Or? All right. Well, thank you for that, kicking it off. So why don't we shift? You know, different investors have different kinds of profiles and have to maybe adapt differently to the uncertainty. Seth, you've seen a lot of cycles in cannabis over the years. How are investors recalibrating? You know, their
I don't know.
thesis?
You know, I mean, I have to be blatantly honest that what happened, you know, last weekend, none of my instrumentation is working, right? Like my control panel, you know, like that movie where the compass spins around. Like I don't know what the hell is going on. And I think you have a lot of people that are doing that as well on the capital side. And if you're in a scarce capital environment prior to that, and now, you know, the hemp thing happens and the hope of potential rescheduling is very fuzzy. I think unless you're already invested in something, it's very hard to deploy capital. To be a little bit more optimistic, I do think there are still states that are functioning. So I'm going to go to New York next week, and it's, you know, 2014 in New York, right? Like everyone's making money and they're happy and people are cutting checks. And so I don't know. I think it just depends upon the geographic, you know, domain that you're looking at and what your lens is and what your strategy is. But I think I've gotten more calls in the last week, like literally, than I've ever gotten about what's going to happen. And I don't know.
Yeah.
You know, I don't know.
Is following on with that, are you seeing the new investors come in, or is it traditionally, are you seeing more legacy type investors or new license holders?
Look, I think everyone has a story where you know a company where they've privately funded through 2 or 3 extremely wealthy people and in the private credit or private equity markets, and I still have 2 or 3 of those. But I think, you know, when you have the kind of confusion in market that you've had in the last 10 days, I don't think you're seeing a ton of fresh capital show up for anything outside of things in 2 or 3 states or a refinance for something large.
Thank you. Dennis, you have a different kind of vantage point. What are you seeing in the capital and how things are being structured? Anything differently to manage risk and compliance?
Well, I just say your capital strategy is probably the most important thing as an operator that you should do right now. And in times of uncertainty, you should hire guys like Seth to be able to go manage it. If he doesn't know, no one else knows on it. But here's what I'd say overall is you are not going to see a lot of new entrants overall in the U.S. landscape. It's a very micro-driven climate. So there are great states. Missouri's a great state. There's still capital flowing into those states. Most of the investment that we've seen is existing investors having to re-up within their current investments, and that's either from rescue capital because there's nowhere else for them to go, or it's because of working capital because even though a company may be successful, they don't have an opportunity to go outside, and that cost of capital, if you go outside, it is really pressed down by just the industry benchmark standard that investors look at because, as you know, investors are not your friend. They're there to make money, and they're going to take advantage of the depressed valuations in cannabis, even if you're a fantastic company, even if you're in a fantastic market. So I hope for the industry that we get to a place where we're not leaning on debt because debt is very short-term focused. It makes operators think about the next transaction, the next month, the next quarter. Yet on the other side, we have biotech companies that are public companies that have no revenue, that are focused on one molecule as an outcome for a population of 0.1% of the people that go blind after some type of side effect, and they have no problem raising money. They're public, everything else, because those outcomes that they have are completely binary. It's either zero, and the investors know that, or it's $1 billion drug. So I would hope for the industry that we actually do have a mature investment vehicle where there actually are Series A's and Series B's and Series C's and Series D's, but we just haven't had that ecosystem or that maturity because there hasn't been liquidity to be able to feed the system. So you're seeing a really big innovation gap, and what that prevents is just long-term thinking and strategy for the most part.
Thank you.
Can I add just one
Sure,
thing on that? Because
absolutely.
I have a slightly different view, and obviously my specialty is debt, but there's a couple of advantages, right? So when you think about the overall health and how it might impact the industry, I definitely agree with those points. But listen, the clients I work with are putting new money into the space. We've closed an aggregate of close to $100 million in new loans just this year across several clients and several operators. So what are those loans consisting of? Yes, some of them are refinancing, but some of them are growth opportunities. As some of the larger operators are condensing operations and focusing in their core markets, there's a lot of opportunities to buy things in certain states that might be really accretive for smaller growing operators. So growth capital is still alive and well, and I think many of the operators who have chosen to stay focused rather than a quick growth plan have been really successful in some of these growing markets. So there still is an opportunity from that, and I also agree, seeing much less new investors in the space, right? So I'm not seeing, I think 3 or 4 years ago there was constantly a lot of excitement, right? So yes, it's more limited to those core investors, but many of folks, I think people sitting in this room are people who have capital and are still deploying new money loans. So that's still out there, and I think that it's important for folks to realize that there are still growth opportunities. And the upside of debt, right, for these investors is it provides an additional layer of protection versus the equity markets, which I think have really dried up in light of the reform status.
Thank you. I guess following on with that, Samantha, what are some of the things as an attorney, what should investors be thinking about in the context of regulatory risk or trying to manage some of those issues in deploying capital?
Sure. So I agree with Seth. I don't even pretend to say that I know what's going to happen, but that almost makes it simpler from the legal perspective because my job is to help you get paid back if you're doing a loan. So we, in addition to the standard bells and whistles, try to deal for that unknown, right? We don't know what's going to happen in a year from now. So on the company side, with the operators I work with, we try to get that flexibility such that if there is a material change in the next year, perhaps it's the ability to refinance early without a high penalty. Perhaps it's the ability to take large 280E deferrals so that you can get the maximum competitive advantage that all of your competitors are doing by relying on a legal opinion to do that. It's working with an investor that understands the importance of that tax strategy and can think outside the box and not just say, well, you must pay your taxes when they're due because that's what we expect. And I think a lot of the investors that are still active in the space understand that well because these are people who are not lighthearted when it comes to being involved in this industry. So I think the best and most productive relationships right now are with experienced investors in the industry and with operators that are really focused on those core markets.
Thank you. Thank you. So how are you seeing, kind of still following on, how are you seeing shifts in preparing for potential increased banking or other types of things? Are there provisions that you're seeing in the agreements that might lend itself to preparing for the future?
Yes, I think people, again, like want to be optimistic, but unfortunately still stuck living in a somewhat limited world. But there are a lot of banks, like we discussed earlier, that are now able to provide more typical treasury management services. Most of the banks that I work with that are lending in the space are really eager to get that treasury. So by offering more standard banking services and by also then requiring a borrower to use this bank as their exclusive banking relationship, it can be a win-win. And if you are able to obtain that kind of bank financing, it's likely to be the most attractive rate and the closest to what people would see in traditional corporate lending.
Thank you, appreciate it. Kind of staying on this, we're at a policy conference, and I guess to the group, how much of today's capital allocation is speculative on policy changes versus business fundamentals? I mean, is there a lot of,
if you're there's some professional investors in the room today, and hope is not a strategy. We've very clearly seen that. So I don't think anybody today is stupid enough to underwrite that we're going to have a liquidity event based upon federal reform. And if you are, then I just think your underwriting criteria is stupid.
Anyone else with comments? All right, well, we can shift gears. I mean, Adam, your background is really unique in that you've been an operator on both the hemp and marijuana industries, an investment advisor, and now become involved in activities with the NCIA. What are your perspectives on the future of hemp and marijuana and how they may converge? I know we've had some changes this past week, but provide some thoughts on that.
We've all seen the significant shift in the redefinition of hemp, and we should acknowledge there will certainly be hardships with any major significant policy change that affects businesses. At the same time, our only choice is what to do from this point, and I see an opportunity for this moment to serve as a catalyst for bringing more of a consolidated strategy among the intoxicated cannabinoid realm, where through hosting these discussions of marijuana and hemp leadership, it's clear that there's agreement on the vast majority of the policy. But there have been political reasons related to the business positioning that have made it challenging for these groups to be able to align publicly and discuss the same objectives. And so to get everyone rowing in the same direction, it might have been a necessity to get everyone into the same boat. And what this definition does is it places everyone more or less in the same category, and I'm hopeful that we can leverage this moment as a way of creating a more unified pressure on the federal government to end cannabis prohibition as a whole.
You mentioned in
Well, you all have done a fantastic job so far, so thank you for your service. Appreciate that.
So if I know there have been some efforts over the last year to bring different groups together to talk about this issue. Maybe provide some perspectives on some of those conversations that have been going on, although, recognize that it's a difficult road ahead, but maybe provide some perspectives on what you've been working on.
In these processes, they take time. And I've had the privilege of having Eric Berlin from Denton's as part of those discussions. And what we've found is immense commonality in a vision of a market that creates safe, tested products, that has consistent quality labeling, marketing standards at the federal level, one that protects children and keeps intoxicating products out of the hands of minors. And the discrepancies are just in the specifics of how we get there. And it's in those details where we find the most colorful conversation. But a lot of that has also been related to the vast disparity in the positioning between two sides of the same plant. And now that this definition might put those different sides into the same category, we might have an opportunity to go deeper into our policy alignment and start to apply that pressure in more of a public setting.
Well, I heard that Mitch McConnell likes money, so when you go up there and talk to him, you just bring a big bag of money. Maybe you can buy his vote.
I think we just need to take examples of what good looks like. Right now in Springfield, Missouri, there is a group called MOCAN, which is all of the operators in Missouri. And guess what? They all get along and they all make money. There's still transactions that are happening that are cash, that are equity. Everybody's profitable because they all came together as a state and said we're going to be a limited license state. They're close to the regulators. They fight on the same for the same things, and they're all united. It is a massive advantage for them. And the polar opposite is California, where you see everybody undercutting each other, no one working together, everything's fragmented. So I think we just need to be able to take a look and saying, hey, what works in the industry and how do we replicate that?
Thank you. Thank you. Well, following on with opportunities, maybe Dennis will stick with you still. Are you seeing any opportunities for brand differentiation or computer experience that might attract capital in the relative near term or long term?
Yeah, I go back to the barbell example, right? On one side, it's rescue capital, and if you're a private company, yeah, debt's out there. You just need to sign over you have to have real estate to go get the debt, right? So you have to sign over the real estate. By the way, you still need a personal guarantee. You likely need to do your personal home and everything else. It just, the debt's so hard, and oh, by the way, they'll benchmark. It won't be Funcana, where it's 36% APR, but it will be somewhere in the 18 to 24% range, and what a deal, because we won't have a lot of fees on that. So, I think on the rescue capital, it's really hard. On the opposite side end of things, and working capital, there are great companies that are making a lot of money in cannabis and doing really well. I'll name out two. The company that I get asked to be introduced to most often is Alpine IQ. It's a software company that's making money hand over fist, and they do a great job. And I worked with the guys who run it. They were partners of mine in a software company 10 years ago. VCs can't get into that deal. That's how successful they are. And again, they're an anomaly. But I'll call on another one, Jeff Freeman, who's one of the founders here. He's going to be speaking later on. Is Mfused. It's the best 10-year overnight success story that you've heard of in cannabis. They're growing 50% year over year in about 4 or 5 different states. Double-digit EBITDA. And working capital for them is a massive competitive advantage because they get better working capital rates than I believe of any of their competitors. And that is their only growth issue, is how much hardware can they actually have in inventory and what that looks like. So can brands and can there be differentiation? Absolutely. And even in states like Maryland, you're seeing some of the best operators and some of the best retailers have an ability to raise additional equity from their current investors, as well as add on debt. And they're not just expanding to Maryland, they're going to other states like Missouri to be able to expand. So you are seeing some great stories. They are one-offs at some times, but it's not impossible to go do.
The interesting thing about observing the hemp market for 2 or 3 years is that I think there were a couple really interesting companies in the beverage side, and there was a couple interesting companies, innovative companies on the product side, two that come to mind that I tracked a lot. One was called Off Field, and the other was called Feals, F-E-A-L-S. What I'm seeing in certain states, specifically in New York, is the emergence of really interesting and compelling brands. Several of them are local and homegrown, but if you spend time in that market, I think you will see successful companies that are coming to market with really interesting and innovative product and know their customer very well. And two that come to mind in New York are Heirloom and Jaunty, to me, which are amongst the best selling there. And I think they really have the pulse of where things are going with the customer. So,
Thank you. Appreciate that. I guess to the group, we heard maybe on the brand side some software opportunities, whether it's ancillary businesses. What segments of the value chain are you guys seeing that might be investable? And I know it's very difficult right now with the uncertainty, but what might be opportunities out there, and maybe even looking forward as we look out 5 years or 10 years? Is that biopharma? Where are the new opportunities going to be coming from? Understanding the current context we're in is very challenging.
It's important to recognize that there are investment opportunities that are completely insulated from the federal uncertainty. Now, over time, in terms of the hemp-marijuana dichotomy, I envision an initial convergence followed by a divergence into a different form of segmentation. That's going to be the industrial products, the nutritional products, recreational, supplements, and then the biopharmaceutical space. And I have the privilege of advising 3 different biopharmaceutical companies, Deflora, Andira, and Pure Green Pharmaceuticals, which are all using targeted cannabinoid formulations for specific indications. Not only are those companies operating completely within the bounds of federal law, but it's essentially collaborative with federal regulators as they go through the FDA process toward approval to provide more therapeutics for these indications. So I do think it's important as we consider where there is opportunity to invest capital that there are ways of gaining exposure to the therapeutic value of cannabis in a way that is completely federally compliant today.
Any other segments that?
I'll just add one thing, and I think a couple of folks touched on this, but beyond just the companies with the hard assets, I think there is still a lot of continued opportunity with the brands, like Seth mentioned, and we're seeing a lot of continued excitement and success amongst the really, established brands in the space that have really developed a strong following. So I think those brands will continue to grow, and I think there's room for newer up-and-coming brands to also follow suit.
I think if you generate actual cash, it doesn't really matter what segment of the value chain you're in, there will be capital available for you. It's just a matter of price. So, when I'm looking at something for myself or for one of my customers or an investor that I work with, usually the first question that I ask is how much actual frigging cash is there? And if you're throwing off cash, you're probably in the upper decile of companies in the industry, and that'll give you a chance no matter what segment you're in, I think.
Yeah, I'm hopeful, as Adam mentioned, that there's more investment in companies that really have innovative technologies and innovative disruption. We're seeing some of that in extraction technologies and a movement towards solventless, and I think that will be a next wave of products as consumers get to continue to understand and educate themselves around what they're putting in their body and what that looks like. I think they're going to seek more clean cannabis alternatives, and it's great to see. And I know from California, there's a big movement towards that as well. But I'm hopeful that you can't fake the funk in terms of a brand, and you can't outmarket a shitty product. So it has to be a product first, and I think you'll see more of those solventless type of products really speak to a lot of consumers who are looking for a much better and cleaner experience.
I've also espoused several times that I'm on this quest to find the best companies on the planet, right? Like the ones that are generating cash flow and know their customers and have a growth plan. And despite my negativity today, I keep finding more companies, right? I travel the United States, I travel the world. I keep bumping into companies that I've never heard of, that I never knew about, that are generating revenue, that are generating cash flow, that are surviving in cannabis. And I think that's, for me, kind of the thesis, right? Do you generate cash flow? Can you survive to play another day? That's a win. And that's where you have to start your kind of fundamental thesis. But I keep finding unicorn companies, and I have minuscule LinkedIn presence, and I'll keep publishing on them when I find more, because they're coming.
So you just mentioned cash flow and revenues. Are there any other metrics that the panel might be looking at in looking for investments that maybe some others may not be as focused on? Are there things other than just cash flow and revenues, or is at the end of the day that really is the core of success moving forward?
Well, for the earlier stage companies, especially when I'm evaluating an investment, it always starts with the team. Especially within an industry that is subject to so much volatility and regulatory change and shifts in market dynamics. The original business model you invest in is not always the same one that is optimal in 5 years. And what I look for are teams that are not only competent, but also capable of shifting and adapting along with the constantly evolving market dynamics.
I can add one last point,
Sure.
sort of tangential, because I think the items that were already mentioned are probably more important. But we did hear a lot about you've got to own real property to be able to get a loan. And as the market continues to develop, one thing we've really seen evolve over the past couple of years is the intellectual property. So there's another opportunity, particularly for the successful brands, even though it's still, up in the air and there's some unknowns with respect to the federal protection, getting out there and doing what you can to protect that brand early on as it grows has proven to be successful, and I think that's also an additional way that companies can be thoughtful about building their asset value in a way that's attractive to investors.
Yeah, Marc, I think there's a massive opportunity for performing companies and profitable companies right now because there's so many people that are not. And to me, I really look at what does their balance sheet look like? Is their balance sheet upside down? What is their access to capital? And what is their cost of capital on that? And if you have a clean balance sheet and you have some access to low cost of capital, you're super dangerous in this market right now. I mean, it's a massive opportunity for operators to be able to consolidate at a great level. And so that's, I think, what I'm focused on is being able to look at those types of companies that can be aggressive right now.
Okay. Well, thank you. Well, we are at time. I'd like to thank our panelists, Dennis, Adam, Seth, Samantha. Thank you very much. Appreciate it.
Thank you.
All right, so next up,